Yeah, minus 1 plus minus 1, minus 2, minus 3. Five minutes left. We have 2 minutes left. Time is up. Please hand your quizzes in towards the end of each row, either end. It's okay. Yeah. Please hand your quizzes in. Time is up. Thank you. Hand your quizzes in towards the end of each row, please. Time is up. Any more quizzes? Any more quizzes out there? Thank you. Okay. Everybody's quizzes are in, right? So here's what's going to happen. Right after class is over, I will start grading, and I will keep grading till I've finished grading, which will be sooner than you think. And then you will get an email saying the quizzes are done, come and pick them up. If you have some serious philosophical or psychological reason not to have your quiz out there, let me know, because here's what I will do. The reason I asked you to write your names on the back is they will be in alphabetical order, face down. Just pick your quiz. You know alphabetically where you fall. This is, don't go browsing through the quizzes. This is in Barnes & Noble. So basically just pick your quiz, leave. right? If you feel that this is a serious invasion of your privacy having it out there, you need to let me know really soon, like right after this class or while you're sitting here, say, please don't put my quiz out, in which case you will have to come into my office to pick up your quiz. It's not a bad thing. I'm not going to bite your head off, but no. But otherwise your quizzes will go out there and you can pick them up, and I'll send the solution out with the quiz, with my grading template, so it's going to be pretty transparent. You might not like what I do, but you'll see what I've done. Okay? I will screw up on a few of your quizzes, not intentionally, but just because that's the nature of the game, because I believe in speedy but noisy feedback. I'd much rather give it back to you sooner rather than later, because I remember taking quizzes when I was a student and not getting it back 2 weeks later, and by that point I didn't stop caring. So if you find something that you think is wrong, that I've missed on your quiz, and you should be able to tell by the grading template, bring it in, I'll fix it. Don't go to the TAs. They have nothing to do with this process, so don't take it out on them. They have absolutely no role in this particular part of the process. So watch your emails and you will know when the quizzes are done. I know I shouldn't do this, but I do this every time a quiz is over. You want to hit the low points, high points, depending on... What is the big deal in the first problem? Your cash flows were in euros. Your discount rate was not just in the wrong currency, but in the wrong country. In fact, you had an exactly similar problem, I think, 2 quizzes ago. But there it was a developed market company buying an emerging market company, and you had to fix country risk and currency risk going the other direction. So in this case, I gave you the cost of equity in reais, right? What was it? 20%. I want to convert it to a Euro-German cost of equity. So usually when you work with currencies, it's best to do the currency part first and then the country risk part, because if you're in a hurry, in fact, I wrote this entire quiz for somebody who did not have a calculator. Assume you didn't have a calculator. You have a 20% cost of equity. What is the differential inflation? 9 minus 1, 8. What is the country risk? 3. 20 minus 8 minus 3 is? 9. That's it. If you had no calculator, that would be it. There's a long drawn out compounding where you could have come up with a 9.2%, right?
Was it 20 minus 7? Or
20 is it 7 or I'm working. I'm sorry. 20 minus 7 minus 3. Sorry. It's 10. And if you do the compounding, it's slightly lower because of the fact that you do the compounding. What I'm trying to say is, if you're in a hurry and you want to get to a cost of equity in a different currency, go the shortcut. It's going to get you pretty close. So that's the big deal. After you do that, it's a perpetuity 1.5% growth rate. The value then follows. So the big deal in that problem was just getting the cost of equity in the right currency and for the right country. The second problem was, can you do betas? And what you probably found is you either could or you couldn't, right? There are only 2 choices. It's a binary solution. So I gave you the businesses, I gave you the unlevered beta. So you got to take a weighted average. I told you value was proportional to revenue, so you take the revenue weights, you get the unlevered beta. I gave you the debt and the equity and the tax rates. The only thing in the first part of the problem is just making sure you got the weights right based on the revenues. The second part of the problem, I asked you for a cost of equity in euro terms. That's significant, because then the risk-free rate you're going to start with is which one? The German euro bond rate, because you're saying, but it's it doesn't matter if it's a Polish company or a Hungarian company. If your cost of equity is in euros, your risk-free rate is a German risk-free rate. I know you want to punish the company for not being a German company, but wait, you get a chance, right? The beta is the beta you got from part A, but the equity risk premium will be the equity risk premium reflecting where you do business. Everything has its place. And the cost of debt, I gave you the default spread for the company. The only real question I was asking you is, what are you going to add that default spread to? What should you add the default spread to? Country risk premium is an equity measure, right? Basically, you're going to start, so if you want a euro, so let's assume you want a euro cost of debt. Now, you could have done it in a different currency. Euro cost of debt, you're going to start with the German euro bond rate, but then you're going to have to add 2 default spreads, one for the country and one for the company. You'd have got exactly to the same place if you took the, I think it was I think if you'd taken the the country, in this case, if you'd just taken whatever the local risk-free rate was and added the spread, or the local risk-free rate in euros. Basically, there are two pieces, and when you do that, you end up with a cost of debt in euro terms. Net out the tax rate, you got the after-tax cost. The cash flows, I didn't want to make the problem too involved, so I took two slices. One is, can you capitalize leases? The only question I was asking is, which discount rate are you going to use to take the present value? That's the only that part of the problem. That is it, right? And I'll give you the choices. I gave you cost of equity, cost of capital, cost of pre-tax, cost of debt, after-tax cost. It's pretty much the spectrum. One of those is the right answer. The question is whether you pick the right one. In fact, I offered you a fifth choice, which is, maybe you don't want to discount at all. Just multiply 30 by 8 and you get 240. That's a one answer that's definitely off the spectrum. But which discount rate should I use if I'm capitalizing leases? Why pre-tax? Because the lease payments or commitments are pre-tax commitments. It's as simple as that. It's a debt payment, but it's a pre-tax debt payment, so it's a pre-tax cost of debt that you use to capitalize leases. That's always the case. Last problem, the R&D expenses, right? I should be capitalizing them expense. And what's the current year's R&D? It's 100 million, so I shouldn't have I added back. But there's one loose end I have to tie up to do the correction, which is I have to figure out how much of previous year's R&D I'm amortizing this year. I tried to be helpful, though you might not think so. I gave you 90, 60, and 30. You know why? They're all divisible by 3. In fact, this is a problem you can do in your head. 90 divided by 3 is 30, plus 20 plus 10 is 60. You add back 100, you subtract out 60. You got an adjusted operating income. I know the wording was a little messy. You didn't know whether it was your -1, -2, -3, or -3, -2, -1. The reason I didn't clarify is why? I get exactly the same answer no matter which sequence you take. If I asked you how much of the asset is unamortized, then the sequence would have mattered. In this case, the sequence doesn't matter. It's just 1/3 of the total R&D expense from previous years. So I think the corrected number is 25 million. It's -15 plus 12 plus 40. So that's it. Okay. If I've depressed you, I'm sorry, but best to strike when the iron is hot. No. Okay, so here's what I want to do. I want to continue. You got a question, Joseph? Go ahead. Will I include a what? Oh, shoot. Will I include a median and an average? No, I'll give you the distribution. You get a histogram. Okay, so basically, this is why do we give medians if we have the whole data? Well, you might as well see where you fall. So you get the whole histogram. You can do with it whatever you want. My only suggestion is do not overreact. Why? It's only 10% of your grade. In either direction, don't overreact. So if you got a 10 out of 10, wonderful, but it's just the beginning of the game. If you got a 0 out of 10, not so wonderful, but it's the beginning of the game. So either way, just take it as a small piece of input to get the process started. It's kind of an early signal of whether the material in this class is not difficult. It's just a lot of stuff. So while you're listening, you're saying, I get that, 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 I get that. And then you try to do it and say, I don't get that. And sometimes what you get as feedback from the quizzes is you're not doing enough. Doing enough in the sense you're listening to me capitalize leases, but you're not capitalizing leases on your part. So I know I keep nagging you about the weekly challenges and the valuation of the week. Part of the reason I do that is you really don't learn this stuff unless you do it. I mean so if you get a bad grade on the quiz, it might not be that you don't understand the stuff. You might get it, but it's not sticking until you actually do it. Okay. So let's talk about growth rates. I finished last session talking about analyst estimates of growth and why there isn't much stuff there. So if you ask me to summarize what I think about analyst estimates of earnings growth, first, there's a lot less private information in analyst estimates of growth than we think. We think analysts have this access to all this neat stuff that we don't know. Especially in the US, that is no longer true. Partly because of SEC rules and partly because of the nature of the process. Because you have lots of different ways in which information hits markets. It might be different in some emerging markets where managers are allowed to convey information to analysts, so they might get an edge. Second, when analysts get private information, guess who the source is? It's a company. And therein lies a problem, because it's like being a journalist who has a source in the White House. The White House will give you information, but it's not going to give you bad information. It's going to give you information that's favorable to them. So you're getting biased information. Even if you're getting information from the company, you always have to look at it with jaundiced eyes. And third, when I sit down to value a company, I do check out what analysts are forecasting as earnings. It would be foolhardy on my part to act like analysts don't exist or that they know some. But when I get a number different from analysts, rather than bending myself into a pretzel to try to get the same growth rate, I stop and ask the question, have I missed something? Is there something big going on here that I have missed? And once in a while, there might be something in the news that passed through that I just missed. But a lot of the time, I'm going to end up with a decision or a number different from analysts, and that's okay. I'm okay with that, and you need to get okay with that as well, because if you keep going towards analyst estimates of growth, this isn't your valuation anymore. This is the most critical number in your valuation, and you need to claim ownership on it. Which brings me to my third and final way of thinking about growth, which is that companies have to earn their growth rate. You and I don't have the power to go around endowing companies with high growth just because we like them. What do I mean by this? To grow fast, a company has to reinvest a lot and reinvest well at the same time. And that's really tough to do. In fact, let me take you through the algebra of growth so you can see exactly how this process works out, because you're going to end up with an equation, but I want you to see where the equation comes from. Let's assume you have a company which has $1 billion invested in existing projects on which it's making 12%. So right now it's making $120 million. Next year, let's assume this company invests $100 million in new projects and that the return on those new projects is also 12%. So if next year when I look at this company and look at its operating income, it's going to be $120 million plus 12 million, which gives me 132 million. If you think about where that 12 million in additional income came from, it came from the fact that I invested in new projects and that I earned a return on those new projects. So in a world where my returns are stable, the only way for me to grow is to increase my base, right? The only way to increase my base is to reinvest more. That's what reinvestment does. It increases my base capital. If I keep my return on capital constant, that becomes my additional income. In fact, if I took that and wrote it out as an equation, here's what it looks like. I have $120 million in earnings. I put back $100 million, right? So that's my reinvestment rate. So generically think of that as how much I'm putting back. I'm putting back 83.33%. I'm earning a 12% return on it. 83.33% times 12% is the growth rate I got in this year. So when you see these sustainable growth equation or fundamental growth equations, they don't come out of nowhere. There's no elaborate theory. All you need is basic algebra, and you can see that if you don't change your return on capital, the only way to grow is by reinvesting and earning a return on capital on that reinvestment. You're saying as opposed to what? There's a second way to grow, and it's so much more fun. If I can increase the return on capital on my existing investments, I get growth, right? That's called efficiency growth. You're saying, why are you drawing a distinction? Because efficiency growth is finite. Finite in what sense? I can make my return on capital go from 12 to 13, 13 to 14, 14 to 15, but each step is going to get more and more difficult. At some point in time, I'm going to hit a brick wall. I cannot keep going further. Which means you can use efficiency as an argument for short-term growth, but you cannot use efficiency as your rationale for growing for a really long time. So I'm not one of those purists who says if you don't get fundamental sustainable growth, you have no growth. You can grow with efficiency, but for a finite period. So what I'd like to do now is take that insight and use it to talk about estimating growth in different measures of earnings. So I'm going to start with earnings per share and talk about what drives the growth in earnings per share. Then I'm going to go to net income from non-cash assets. I'm going to separate cash from everything else because cash messes everything up. And then I'm going to talk about operating income. And I'm going to look at how much you reinvest and how well you reinvest with each measure. And what you're going to see are very subtle differences in how I define reinvestment rate and return on investment. Let's start with earnings per share. With earnings per share, I defined reinvestment rate as the retention ratio. You know what the retention ratio is? Is if I pay out 30% of my earnings as dividends, 70% gets retained. So it's the retention ratio, and I define how well I reinvest with my return on equity. Retention ratio times return on equity is my expected growth in earnings per share. If you move down to growth in non-cash net income, which is not a per share number, I'm looking at the aggregate number, then I defined reinvestment as how much I'm actually reinvesting. I'm no longer using the lazy definition of whatever's not dividends is reinvested, because we know that's not true. Know what I mean by no, it's not true? Yesterday I put up the Apple valuation. We know they don't know that what they don't pay out doesn't get reinvested, because we see the increase in the cash balance. So when you look at non-cash net income, I'm actually going to explicitly look at what you reinvest, because we can see it, right? CapEx, depreciation, working capital. And I'm going to also allow for the fact that some of this may be funded with debt, and I'm okay with it if it's a normal proportion each year. And I'm going to divide by net income. I call that the equity reinvestment rate. It's very similar to the retention ratio, but I'm no longer just trusting that what you don't pay out as dividends gets reinvested. I'm actually checking to see what you reinvest. And when I look at returns again, I'm going to look at a non-cash return on equity. You're saying, what the heck is that? Normal return on equity, I take net income divided by book equity. But if I have a lot of cash, that can be a very misleading number. Think of why. When you take Apple, in their book equity is a lot of cash, right? What's the return they're earning on their cash? Close to nothing. So when I look at the overall return equity for Apple, it's being dragged down by the fact that they have a lot of cash. So if I'm focused just on the non-cash net income, I'm going to take the net income from non-cash assets, which you get by subtracting out the interest income from cash, and I divide by book equity minus cash, non-cash return equity. So retention ratio, equity reinvestment rate times non-cash return equity. And finally, I look at operating income. Here, rather than focusing on net income or earnings per share, I look at after-tax operating income. And I look at reinvestment again as net capex plus change in working capital. But here I don't allow for any debt or equity cash flows, because this is to the whole business. That's called the reinvestment rate. And here, when I look at how good your investments are, I'm no longer concerned about just the equity. I'm looking at the entire invested capital, return on invested capital. It looks like they're three different equations, but they're the same equation, kind of framed differently depending on what you're trying to measure growth in. Yes?
How would the second one change if you're looking at a bank?
First, if you can define capex, depreciation, working capital for a bank, all the more power to you, right? In fact, we're going to talk about how to adapt this for a bank, because I don't think any of the traditional cash flow equations work. Okay? Because you can't define working capital, you can't define capex, you can't even define depreciation. But we do know banks need to reinvest. In fact, let's open the window. For a bank to grow, what does it have to reinvest in? There's a much stronger, more binding constraint. Think Basel. You think Switzerland, skiing. No, not then. So kind of bring you back down to finance, right? What do they have to reinvest in?
It's tier 1 capital.
They need regulatory capital, right? To grow, you need regulatory capital. So if you're an investment bank or a bank and you tell me I want to grow, you know what I'm going to ask you is?
Raise more capital.
You got to come up with regulatory capital. And if you don't have it, you either have to raise it or cut back on dividends. So I'm going to actually define reinvestment as a bank as what you need to invest in regulatory capital. Because I give up on the traditional assets. I don't even know what to do with it. But it also effectively means that if you're an undercapitalized bank, you're going to have some serious issues growing, because you've got to first get back to steady state before you can have growth reinvestment. So it allows us to tie the growth in banks to what I think is the most critical factor. Next week I'm going to try to value Santander as the valuation of the week, partly because I want to torture myself. Okay? And those of you tracking Santander, it's gone through these contortions in these last few months of having to raise fresh equity because they're tremendously undercapitalized. So there you're going to see the big challenge in valuing the bank is coming up with that regulatory capital increase, because that's going to form the equivalent of reinvestment at a bank. Okay? So here's what I'm going to do. I'm going to start with growth in earnings per share. Retention ratio times return on equity, right? What did I say the retention ratio was? It's whatever you don't pay out. So it's the highest number a retention ratio can be. It cannot be greater than 100%, right? Which actually brings in a fairly serious constraint on earnings per share growth. In the long term, what have I just said? Your earnings per share growth cannot exceed your return on equity. So if you have a 7% return on equity and you give me this plan where you tell me you're going to grow earnings per share by 25% a year, I'm going to say stop. Before you get too excited about these numbers, resolve this basic contradiction for me, because you cannot have a 7% return on equity and a 25% growth in earnings per share. So When you talk about earnings per share growth, retention ratios kind of cap the growth rate at the return on equity. Okay? So let's take an example. This is Wells Fargo in 2008. It's one of the last vestiges of the dividend discount model for me. Is some banks are still value using a dividend, far fewer than I used to. The return on equity based on 2008 earnings, just pre-crisis, this is what Wells Fargo looked like, was 17.56%, and the retention ratio was 45.4%. Let's say I'm valuing Wells Fargo and I take these numbers as steady state numbers. You know what I mean by steady state? That they can maintain this for the near future. If they can maintain those numbers, my expected growth rate is going to be 45.37% times 17.56%, which gives me a growth rate of roughly 8% a year in earnings per share. Conditional on both those numbers staying as they are. Any questions on the mechanics? Now let's ask a what if question. Crisis happens, and one of the things that happened, so let's say it's the day after and the crisis happens. None of the numbers in your financials have changed, right? The return equity still looks like it did yesterday. The retention ratio still look like it did yesterday. But now let's assume there's been a crisis and the banking regulatory authorities have woken up to the fact that banks collectively don't have enough regulatory capital. So an edict gets passed. Every bank needs to increase its regulatory capital by 30% starting right now. First, is this good news or bad news for you if you're a Wells Fargo investor? It's what? It's bad news, right? But the question is, how are you going to show this in your numbers? Yesterday you told me an 8% growth rate. Now all that's happened is the regulatory capital has been raised. How are you going to reflect that in your expected growth rate? What's going to change? Yeah.
Well, the retention ratio is going to go up. Right?
Well, let's start with the return equity. What's return equity? Net income divided by book equity, right? So if you buy into the regulatory authorities, whatever they just told you, your book equity has to increase by roughly 30% just for you to do what you did yesterday. In other words, to earn the same net income, you now need 30% more book equity. So my 17.56% will become 17.56 divided by 130. Do you see what I'm doing? I'm just increasing the denominator, which is going to drop that 17.56 down to 14 or 14.5%. And even if they chose to pay what they did yesterday's retention ratio, which is going to be really tough to do, my expected growth is going to be lower. I agree with you. Now with the higher regulatory capital, they're not going to be able to maintain the growth they did by retaining what they did before. They will have to retain either more or cut. There's got to be something that changes in the process. But the big number that's going to change when regulatory capital changes is returns on equity are going to decrease. So if you're valuing banks, even if you don't use the dividend discount model, this is the other shoe waiting to drop around the world. Is returns on equity can look really attractive, but if capital requirements are raised, returns on equity across the board are going to decrease. And when that happens, you have lower growth in earnings per share and lower value per share across the entire sector. So retention ratio times return on equity. So I'm not sure what the numbers worked out to. I think if I leave the retention ratio unchanged, the growth drops to 6.13%. Basically, all I did was adjusted the return equity from 17, because if you increase the denominator, the return equity drops to 13.5%. And if you go in with that higher, that lower return equity, your growth rate now becomes a much lower growth rate. Yes?
If your return on equity drops, but consequently you also raise your retention ratio, could the expected...
Could be. You could end up with the same growth rate, but here's what's going to happen to your value. You'll have the same growth rate, but the dividends you'll be paying out will be less, right? So no matter how you slice it, the value per share is going to go down. So they can try to maintain the same growth rate, but to maintain the same growth rate, they'll have to pay out less in dividends. Or they can accept a lower growth rate and pay the same dividends. Which one should they do? You got to work out the math to see which one's actually better. I can't tell you ex ante which one's going to be better. But those are the choices you will face as a bank, and neither is a good choice. Banks like to do, they don't like to cut dividends, and they also don't want to deliver a high growth. Right? Now let's talk about this return equity number. So clearly, holding all else constant, if you're focused on the value of equity, you want a high return equity, right? There are two ways you can deliver a high return equity. One is to take really great projects, but that's a lot of work. And many companies might not be able to do it. But if you look at a Google or an Apple, tremendously high returns on equity, even if you capitalize R&D. You know what the other way to deliver a high return on equity is? Real estate people are masters at this. What do? You take an average investment, you go borrow as much as you can, and use the fact that the returns you're making on your investment exceed your after-tax cost of debt, and that kind of magnifies the effect on your return on equity. In fact, mathematically, the return on equity for a company can be written as the return on invested capital plus a leverage effect. You say, what leverage effect? It depends on how much you borrow and what you make as a return on this project that exceeds your after-tax cost of debt. So you're putting your returns on steroids, and debt's basically acting as a steroid, pumping it up. But as A-Rod discovered, steroids do have a dark side, right? And the dark side is your return on equity can get pumped up with leverage, but what else is getting pumped up? Your beta and your cost of equity are also getting pumped up, and that's not a good thing. So this is not, it's a mixed blessing. I don't know why generation after generation we wake up to this reality, but leverage can pump up your return on equity, but also pumps up your cost of equity. Rajiv? It is gross debt. I use gross debt and I focus just on the non-cash portion, but if you want to make it net debt, you can also use it as net debt. So just be consistent. If you decide to go the net debt route, you can live with either one. Right? So let's look at an example of how return on equity gets pumped up. This is a very old example. In fact, it's so old that this company has not been called Brahma now for about 15 years. But Embev, which is Latin America's largest beverage company, used to be called Brahma. In the late 90s, I remember doing an analysis, the first time in Brahma. I was impressed. I'd never heard of the company. They had a return equity of about 31%. I said, how did they deliver a 31% return equity? So first thing I did was I computed return on capital. It's already impressive, close to 20%. They had a debt to equity ratio of about 77%. And this is one of the few places in finance where we're doing everything in book value terms, because return on equity is a book value measure. Their cost of debt after tax was 5.6%. So here's what the math looks like. 19.91% is the base. If they'd had no debt, their return on equity would be 9.9 plus 0.77. That's the debt to equity ratio. Plus the benefit to them of borrowing money is an extra 14.3%, pumping up the return on equity for every additional dollar of debt they take. There you go, 31%. But here's the way I would use it. You give me two companies with a 31% return on equity. One delivers with no debt and one delivers with 77% debt. Pick the company with no debt over the one with 77% debt, because it comes with less strings attached. Any questions? Now, I go back to India about once a year, and when I do go back to India, my people somehow find out through the grapevine that I'm coming, and usually I start to get all these invitations starting about 4 weeks. And you're in India for those 2 days. Can you come into our company and talk about this? And my answer is, are you kidding me? Hey, I'm not coming for 2 days and jumping all over the country. So India is not like New Jersey. You don't jump from, you leave and go to another part of the country. That's 2 days right there, getting back. So, but I get trapped when one of my relatives says, will you do it? Especially if it's an older relative. So my uncle used to be the chairman of the board of a company called Titan Watches, which is actually a well-regarded watch company in India. So this was about 10 years ago. He said, we're having a problem with the company, and we'd like you to come and take a look at it. So what's your problem? He said, we've been reading these books about how to use leverage to pump up return equity, and we keep using debt, and our return equity keeps going down. They said, okay, maybe there's a problem. Let me take a look at what's going on. So I took a look, and here's what I found. They had a return capital, which wasn't bad. It's a rupee return capital, not bad, of 9.5%. But these were in the days when Indian rupee risk-free rates were in the double digits. Their after-tax cost of debt was about 10.125%. I don't have to go any further, right? See what's happening? This is the definition of insanity. You keep doing the same thing over and over again. You're going to get the same outcome. Every dollar you borrow, you make $9.50. You pay out $10.1. You get leverage is not always. That's why it's called a double-edged sword. Is if your return drops below your after-tax cost of debt, God help you. And what makes it even worse is if your return becomes negative, you lose the tax benefit as well on your debt. Both sides start pulling in different directions. You can end up with some really bad returns on equity if you borrow too much money. So it's not an automatic that if you borrow money, your return on equity will go up. The minimum you need to earn more than your after-tax cost of debt, but that doesn't mean your value of equity will also go up. It's just the mathematics will start pushing up your average return on equity. So that's earnings per share. Let's move to non-cash net income. Now clearly again what I'm trying to do is separate cash from other assets. Joseph?
So the reason that your cost of debt goes down is because of risk of financial distress, right? Is that
No, first there's a very simple reason why the cost of debt is always going to be lower than the cost of equity, which is?
tax benefits?
No. You're the first guy in line, I'm behind you in line, right? You're the lender, I'm the equity investor. So if you charge 8%, I should charge 12%. So almost to start the process, equity should demand more. You add the tax effect on top, the difference is going to get even wider. Don't go to the limit there, therefore, which is cost of debt is lower than the cost of equity, therefore I should go to 100% debt. That doesn't work because there's all these dynamic effects you create. But debt is going to be cheaper than equity even without the tax benefits.
No, I'm saying the reason that your cost of debt goes up as you raise more debt.
Think like a lender, right? Now, there's a very simple reason. You're lending to me. I have no debt, you lend me at a particular rate. 1 year from now, I come to borrow more money, and you discover that I owe $3 million to other people. Do you think my default risk has gone up?
Yeah.
That's it, right? So as you borrow more money, the rate at which you can borrow money has to go up simply because you owe more money. That's more default risk. You take more default risk, your cost of debt. And that's going to be true for every business, no matter how big, is at the margin, additional debt cannot make you safer. It will make you riskier.
And that's the same for cost of equity?
The same thing for the cost of equity. Again, the same thing, which is you have the residual earnings, and that residual earnings becomes more risky the more money you borrow.
Got it. Okay.
Now let's talk about non-cash net income and non-cash return equity. Again, the reason I'm doing this, and this is I think particularly critical in the world we're in now, where companies have these huge cash balances, is we're lazy and we compute things on a consolidated basis. We might be missing big shifts in the risk of a company. So Apple right now is 22% cash, 78% computer, smartphone, tablet business. The cash business is really easy to value. It's there. Why are you messing it up by bringing it into the rest of the business? So in fact, to value Apple, it's probably best to keep the cash business separate and focus on the non-cash business. And ask what kind of reinvestment are you making in this business, the non-cash business, and what kind of return on equity you're earning in this business. So my equity reinvestment rate looks at what you're reinvesting into your operating assets, which is capex and depreciation, which would include R&D for Apple. And if you're using some debt each year to cover that, that's fine because you're an equity investor. You might say 10% comes from debt, 90% from equity. So I'm going to look at the equity reinvestment and divide by the net income that you get from your non-cash assets. Incidentally, on Capital IQ, you look, there'll be a net income number. There's also a number that tells you what the investment income from cash is. So basically, if you want to net it out, it's right there. So I compute a non-cash return equity. So think about the contrast. When I did earnings per share, I used retention ratio and return equity. When I look at non-cash net income, I'm looking at reinvestment rate times non-cash return equity. Look very similar, right? But let's focus in on the retention ratio and then the equity reinvestment rate specifically. What did I say the highest number of retention ratio could be? Can't be more than 100%, right? What's the highest number an equity reinvestment rate can be? Is it? Can I reinvest more than my net income?
Yeah.
Sure. By doing what? By raising fresh equity. I can't do that on a per share basis, but in the aggregate, there are lots of companies that do this. So the equity reinvestment rate is no longer capped at 100%. I can grow faster than my return equity. Doesn't make it a good thing because I'm issuing shares like crazy, but my equity reinvestment rate is not capped at 100%. It can be 300, 500, 800, 5,000%. What's the lowest number a retention ratio can be? You can't go below 0, right? You pay out 100% of your earnings as dividends. Can an equity reinvestment rate be negative? Look at the numerator. What is it? Capex minus depreciation, change in working capital. So if I don't reinvest any money and have a lot of depreciation coming in, you could end up with a negative equity reinvestment. You're saying, what does that mean? What does that mean when you have a negative reinvestment rate? You're shrinking the business. And you might be doing it deliberately because you're in a bad business. So there's nothing, again, wrong with it. But you can see the benefits of moving from a retention ratio where I've artificially capped it at 0 and 100% to an equity reinvestment rate is I can now look at companies like Tesla and companies that, like JCPenney on the same template, because I can allow for negative reinvestment rates and hugely positive reinvestment rates in the process. So I'm going to try this. I took Coca-Cola in 2010 and decided to compute the growth in non-cash net income. So I took their equity reinvestment, which is capex minus depreciation plus change in working capital, but they did borrow $150 million during the year, so that's not equity funded. So $957 million in reinvestment, equity reinvestment. Their non-cash net income was $11.809 billion, which is the total net income minus the interest income from cash that they got. So I took that out. And the non-cash book equity is the total book equity minus their cash balance, $7 billion. Their equity reinvestment rate is tiny. They're reinvesting very little. Their return on equity is stratospheric. Why is that? What the heck are they reinvesting in? More syrup? I mean, this is a company essentially where unless you start counting in advertising as part of the capex, you're going to get this kind of number, which is a really low reinvestment rate, a really high return on equity, and a really low number times a really high number can still give you a pretty reasonable number, right? So you can still get growth rates of 5% with relatively little reinvestment, but as a stockholder, this is great because you get that 5% growth rate and almost all of that net income is yours because they don't have to reinvest very much. So that is if you're focused on non-cash net income. Last step in the process, let's talk about operating income. Again, very subtle shift. I've gone from equity to the entire firm. So my reinvestment rate is net capex plus change in working capital, but now I'm dividing by after-tax operating income. At some point in time, this will become second nature if you start thinking about it consciously, because there's always a consistency here. When I'm focused in the business, I'm focused on return on capital, I look at growth in operating income. Everything I measure is on a pre-debt basis. When I'm looking at equity, everything gets shifted to an equity basis. So my reinvestment rate is net capex plus change in working capital divided by after-tax operating income. My return on invested capital, perhaps the most computed number in corporate finance and the most screwed up number in corporate finance, is after-tax operating income divided by book value of debt plus book value of equity minus cash. You know why that should scare you? Every number in this equation is a accounting number. EBIT, effective tax rate, book value of equity, book value of debt. Cash, maybe. Even that is a little bit of an accounting number. You see why that should worry? Because everything accountants do then will affect your return on invested capital. They're saying like what? You do a big stock buyback. What's going to happen to your return on invested capital? It's going to go up. It's not because you took great projects, but because your book equity shrinks. You take a big write-off because you screwed up. What happens the day after you take the write-off? Your return on capital jumps. It's a number that you should use with caution because when you compute for your company, it can look really good, but for the wrong reasons. It's not because they're taking great projects, but because it's an accounting number. But to the degree that you buy into that return on capital and reinvestment rate, your expected growth in operating income is a product of those two numbers. And everything I said about equity reinvestment rates applies to the total reinvestment rate. It's not capped at 100%. It's not floored at 0. It can be negative. It can be hugely positive. And that's, I think, something to keep in mind when you think about these three different definitions. So just to give you a sense of how different these numbers can be, I took Cisco and Motorola, two very different companies. Cisco's reinvestment rate, this is in 1999, the peak of Cisco's success. And there's a lesson here. Because if you take the 99 numbers, their reinvestment rate was 107%. So what are they doing? They're actually issuing equity. They actually never issued shares to the market. You know how they issued equity? Is when they did acquisitions, they paid with shares. We talked about this. The reinvestment rate is greater than 100%. What made them such an impressive company in the 90s was their reinvestment rate stayed above 100%, but they delivered returns on capital of 25, 30, 35%. And if you deliver a 34% return on capital with a reinvestment rate of 107%, guess what? You're going to deliver an astonishingly high growth rate because you pulled off one of the toughest tricks in corporate finance, which is to have a high reinvestment rate and a high return on capital at the same time. But everything comes with a time clock, right? What made Cisco so successful in the 1990s was what? Issuing equity, buying companies, turning them around, delivering it. What made them so unsuccessful in the next decade? Issuing equity, buying a lot of companies. You can see they didn't change the way they behaved, but the world shifted around them. So if you looked at Cisco in 2009, 10 years later, the reinvestment rate was still high, but the return on capital had collapsed down into the single digits. Companies change, markets change, and you can see that reflected in the value of growth. In contrast, if you look at Motorola, 53% reinvestment rate, not bad, right? 12% return on capital, not bad. But you multiply not bad by not bad, you get not bad. Which is what you get. You get a growth rate of 6%. Would Motorola like to grow like Cisco? Sure, but pigs can't fly. If you're stuck with a 50% reinvestment rate and a 12% return on capital, you're not going to be able to grow at 35%. It's actually a great way to start disentangling what's driving a process is to look at where those returns come from. Now, when I set up the equation, I said there's one escape hatch. Escape hatch in what sense? A company that reinvests very little and has a low return capital might be able to grow fast if it's able to improve its return on capital. To see the mechanics, think about the following. Let's suppose you have a company which has a 5% return on capital this year. Reinvests nothing, but is able to double that return on capital to 10% next year. What's the growth rate going to be next year? Just put in some numbers. 5% means you made $5 this year. 10% next year means you made $10. 5 to 10 is 100% growth rate. So how the heck did they do that? Well, if you improve your return on capital, that is the efficiency growth. And the irony is, the lower your return on capital, the greater the payoff to improving your return on capital, right? So if you have a 35% return on capital that you make 40%, that's only a 7% growth rate or a 14% growth rate, 5 over 35. But if you take a 5% growth return on capital and make it 10%, that's a 100% growth rate. So if any of you are working with companies with terrible returns on capital, this might be the one bright spot here is you have much more scope for efficiency growth. And that efficiency growth shows up as an additional growth rate. So I took Motorola. Remember the 12% growth rate? Or 6% growth rate? At the time that I did the valuation, there were people who complained that I wasn't capturing the fact that Motorola was kind of changing its business model, trying to improve its returns. And I said, okay, you're right. In fact, at the time that I did this analysis, the sector's return on capital was about 22%. I said, what if Motorola can improve their return on capital from where it is today, 12%, to about halfway to the sector average, 17%. And let's say it'll take them 5 years to do this. They're not going to be able to do it next year. How much higher will the growth be? You see the question I'm asking? The growth was about 6% with the original numbers. How much higher would the growth be if they're able to get some efficiency? The answer I got was about 16%. In other words, they can get an extra 9% of growth. And what I did was I took the improvement from efficiency and I spread it out over the 5 years. So effectively what I'm saying is this is the one time when you can look at an intrinsic growth rate and say, I'm going to use a much higher number because I think my company can improve its efficiency. And that efficiency growth will show up over the next year, the next 3 years, the next 5 years. And just the pure algebra of going from a 5% return capital to 10% return capital will push up your growth rate. So I'm going to give you a challenge here. I'm going to give you 5 companies, and we'll make this the last slide for today. And I want you to look at these 5 companies. And they all have exactly the same growth rate, expected growth rate, and rank them as an investor from the company with the most valuable growth to the least valuable growth. So I'll go through the companies, and as I go through it, I want you to start thinking about which of these companies would you like to invest in as an investor. Right? They all look the same in terms of bottom line. Company 1 has a reinvestment rate of 20% and a return on capital of 50%. So 20 times 50 is 10%. They have no improvement in efficiency. Their existing assets stay at 10%. Company 2 has a 100% reinvestment rate and a 10% return on capital, which gives it a growth rate of 10%, no reinvestment. Company C has a reinvestment rate of 200% and a return on capital of 5%, growth rate of 10%. Companies 4 and 5 actually have, in addition to growth from new investments, have an improvement efficiency growth. So let's start easy. Which of these companies has the least valuable growth? In fact, might even be negative. They all have 10% growth rates, but one of these 5 companies I think you shouldn't even think about touching, because even though it's growing, no. Which of the 5 companies is a disaster? Nick? And what about 3 bugs? They're growing fast, but they're reinvesting like crazy. 200%. Their return on capital is actually lower than their cost of capital, which means they're destroying value at hyperspeed. So company 3 is on. Which of these companies is running in place? You see what I mean by running in place? It's growing, but it's doing nothing to its value. Company 2 is running in place. Why? It's growing, but it's earning a return on capital roughly equal to the cost of capital. So the growth, even though it looks good, is creating no value. Little better than 3, but no. If you were a long-term investor, 3 is definitely off the radar. 2 is really you're standing in place. 1 is your best choice because this is a company that can maintain those numbers, is going to have insanely good value from growth. It's like Coca-Cola. What about 4 and 5? Well, those are not bad marginal investments, right? Because firm 4 creates no value from new investments, but at least for next year you will get a really high growth rate, and you can, it's the icing on the cake. You take it, but don't hold on to it beyond that, because once that improvement happens, it's going to revert back to being neutral. And the same thing with company 5. Company 5 is going to have one big year of growth because they improved the return on capital, and then it's going to go back to being a 0% growth company. What I'm trying to kind of bring home is not all growth is created equal, but all too often when I see investors look at growth, they get dazzled by bottom line growth or top line growth. And nobody seems to want, or very few people seem to want to stop and ask the question, how much did that growth cost me? Because growth at any cost is an extremely dangerous strategy to go for. Yes, Joseph?
What if we see firm 4 or 5 and we anticipate that in the future
They can continue.
they could get efficiency growth?
You know what you should check? Check the industry average. Right? If they're way below the industry average, maybe there's leeway, but if they're getting pretty close to the industry average, you should stop, because it's so that's the advantage of doing this. So, I mean, some of you might have heard of this term, growth at a reasonable price, GARP. People use all kinds of sloppy shortcuts for it. If you really want growth at a reasonable price, there's no substitute for doing your homework and figure out what you're reinvesting and how quickly you're growing. I'll see you on Monday. And again, I'm sorry I did not send you the review session, but I will send it to you right after the class if you watch it. Right, okay?
What I was trying to do is confusing me is that can we use the cost of equity of higher when we value the higher?
You can do it in the same business. You can use the beta of the acquirer.
Yeah, but they have a different equity risk premium.
That's fine. The beta is the same. You have to use a different risk. That's why I said you have to take the country risk out.
So beta includes
This equity risk premium has to be the German equity risk premium.
yeah, but Romero's cost of equity include
So take it out. It includes a Brazilian risk premium. So you can take it out. If you take out the Brazilian risk premium, you will have a German. You will have the German equity risk premium. I told you how much of Romero's cost of equity was Brazilian country risk, right? 3%.
3% is the risk premium of Germany, right?
No, Brazil.
Oh yeah.
So all you need to do is take out the risk premium for Brazil, and you're going to be left with.
So
That's a country risk premium for Brazil. That's the additional premium you charge for Brazil. You take it out, you're going to be ending up with a mature market premium for Germany.
so it's going to be so you can just subtract 3% from 20%.
And then take out the currency difference, because you got to make it euros. It's 2 steps, right? You got to take out the currency risk and the currency difference and the country difference. That's how you end up with about 10%.